Okay, all set. How's everyone doing? How is the new administration treating you? Morning, Tree. I think you can unmute yourself if you want to talk. Uh,
All good, Vivek. Bye. Good morning.
hey, morning. Good to see you, Aditya. Vic G. Hello,
Hi.
Vic.
Yeah, hi. Hi, everybody. This is Vic. How are you, Aditya? This is my first time, so not sure what to expect.
But you must have had some expectation. I think I need to know what are you expecting from this?
Well, I'm an individual investor, but also manage a small family office, a tiny one. So I'm always in this world all the time, reading, analyzing things, connecting with people. So information exchange is great. Insights are good. Whatever I can add or I can get is great.
Yeah, cool. No, welcome. Yeah, I think most of us out here are individual investor. Maybe you have a home office or a family office. We are all a big family, but we are managing our own money. Let me put it that way.
Yeah, I would say it's about the same. Yeah, I mean, it's just family and friends. I'm not managing it for some strangers.
Yeah,
Just family and friends. Yeah.
yeah, got it. Yeah. So yeah, me personally, I focus on long-term investing. Basically, buy the greatest companies to build wealth, and then on top of it, use the options to generate cash flow. That's my strategy.
Yeah. Okay, that's the same. Yeah, that's my foundation as well.
Yeah.
There's always a little bit of trading here and there, that you can take advantage of, but
Yeah.
that's the foundation. Yeah.
Correct. Yeah. All right. Good. Uh, I think by this time we have a little more folks joined, and I did not realize that in the meetup, the recurring meeting had finished last week, so I had to set it up again. So some of the folks may thought that there is no meeting happening. I don't know. Sam says, "Can we go to annual meetings? Which is this virtual malarkey? Which annual meeting, Sam, you're referring to? Sam? I don't know nowadays. Do they even have the shareholder annual meeting in person? I mean, I'm for the first time, I'm going to Berkshire Hathaway annual meeting uh, this year, and it's I think it was like Thursday. So yesterday or Thursday, I actually received the paper proxy form and the meeting. The document for annual meeting. I asked Fidelity that I want to go in person, so they sent it to me. And I today morning I went and put it in the post box. I requested for credentials to attend the meeting. So let's see if I can get the credentials in time. I'll go and attend the meeting. Otherwise, I'll have to fly in a day, maybe a day early, to go and get the credentials on the spot. But yes, this was my bucket item, a checklist to go and attend a Berkshire Hathaway annual general meeting. So, which is I'm gonna check it off my list this year. Morris, markets are not at all friendly this month. I mean, this whole year, I think that's fine, but it's only a month or only 3 months, right? We're close to ending a quarter. In another couple of days, the quarter will be over. But I have a few charts that I want to share. I think probably those are appropriate in today's condition in terms of, we're feeling jittery about what's happening in the market. And, in fact, I read some articles in terms of, I think it was either an article in Barron or maybe a news item in Wall Street Journal, which is talking about some of those new investors, right? Millennial investors, they have actually pulled out of the market from the US market and then have invested in the European market because this year European market has done better, especially Germany, etc., because they have opened up their liquidity spigot, wants to invest. And the overall difference between the US and the European market has been close to 15 to 16 percent, and millennials are now flocking over to European market, but doesn't really matter. If it is a good company and a good business, I guess this time shall pass. It always happens. The volatility is the price that we have to pay to enter the arena, right? And so I'm still invested. I'll share some charts which talks about different kind of investors. I think it might be a repeat. I probably have shared this maybe a year ago, but it will be good to go through those charts again. iPhone, we should check Rider for stock analysis, Rider systems. So you have to give me two things, whoever is behind that iPhone. One is who the CEO of the company is and what is the market cap of company. Then I will bring it up next week for discussion. And you also have to, it's not going to be a one way, right? It's going to be both ways. We're going to learn from each other. So you also need to bring up the story, because I don't own the stock. So I don't know the story behind the stock. I'll bring the numbers. I'll tell you what I am seeing by looking at the numbers, but you have to tell me what the story behind the stock is. So iPhone, give me the CEO name and the market cap of the company, and I will then bring it up for discussion next week. Rider systems. Okay, what else before we jump on to our discussion? So this week probably going to be light. I think it's going to compensate for our previous week discussion where we had, I think, a lot of in-depth discussion around the stocks, basically numbers and the stories. We looked at 3 stocks, talked about what we see from the story perspective, what do we see from the numbers perspective. Then we dug deeper into the Coreweave pre-IPO, and you know what my opinion was, right? I'm not gonna touch that stock with a 10-foot pole. There are so many red flags that I shared with you guys after going through the S1. Multiple point of times I had a cringe feeling while I was reading through the S1, right? So we'll give you some update on, I think, on Coreweave. Finally, maybe market woke up, right? It's bankers will try to sell whatever they have, but we have to be careful in terms of what we want to own. Ashwini say, short it then? No, I'm not the problem in shorting is market can stay irrational longer than your portfolio can stay solvent. So I'm not going to buy it, but I'm not going to short it. So that's the difference. I'm not going to short it, even though I don't like the business, and I'll give you a lot of reasons from S1. I'll give you some more today, but I'm not going to short it. I mean, have we not seen many of the short sellers going out of business just because they became too cocky, right? Right from on the Melvin Capital. Then we saw Carson Black. He moved from a short to muddy waters, right? And then most recently Hindenburg, right? They also now stopping the being a short seller. So I don't like shorting. If I were to take a, like, say, negative delta position, I might do a call spread or maybe buy a put spread, which is not my favorite one, but if you push me towards it, but I'm not going to short it. Markets can stay, a stock can stay irrational. GME has told everyone, right, the things that can happen in the market. So I'm not going to short it. Did you hear about UAE investing 1.4 trillion in US over next year? I think this is like, these news have been around. I don't know which one to believe, which one not to believe. All I know is UAE has been trying to diversify out, reduce the dependency on their oil to run their country for almost, let's say, 5-6 years already, right? So they have been buying up assets in US. They've been investing into venture capital, like through SoftBank, right? If you look at the SoftBank Vision Fund, one almost, I think, out of $100 billion, maybe around $40 billion came from UAE, right? Including Mubadala and PIF. So, and then they've been buying up properties in US. I don't know which one is this one. So Aditya, I've not read through this one.
Yeah.
Okay, so basically doing AI semiconductor
Yeah.
infrastructure. Sure.
Yeah. It was interesting to me because I initially saw this on LinkedIn, but I didn't see it in Financial Times or Wall Street Journal or any of the usual ones that I read, and found it interesting. Yeah, just
Yeah,
found
but I
it.
mean, but we do know that these, especially these sovereign wealth funds from UAE, they have been and also Saudi Arabia, they have been investing into many companies in many countries just to diversify and reduce the dependency on oil, because they do see the writing on the wall saying maybe 5 decades from now, the oil will not, be as much in use as it is right now. So
Yeah,
they do want to diversify.
absolutely. Yeah, it was just such a massive amount of money. I
Oh
think it
yeah,
was something, it's almost their entire net worth, or somewhere I read like it's equal to next 18 years of the entire revenue they'll generate from oil,
yeah,
OPEC revenue. So I just found that was a huge, huge bet, given all the uncertainties.
yeah. And again, this is the commitment. I don't know how much will eventually it will result in investment. I mean, we have seen Apple talking about investing $500 billion. TSMC has committed to invest what, $100 billion. SoftBank and with OpenAI, and who are the three? And Larry Ellison, right? Or the whole Stargate project. I don't know. Now, like 100, 200 billion, $500 billion. All these are commitments. We have to see, which one of them actually get implemented. It's not the first time that Apple has talked about investing in US. So we'll have to wait for the
Yeah,
for.
also one point on that.
Sure.
Yeah, I think, I mean, a lot of this, I mean, I think is also politically, uh, kind of inspired, right? I mean, so there's big numbers being thrown around. I'm sure some of it will definitely happen, but I think we just have to remember some of this is political talk too, right? Because I mean, all the countries have to play along as well. All
Yeah.
the CEOs of big companies also have to play along. What I heard was in the first term, also there were major commitments like that, but none of them really happened because things change all the time. So it's yeah here.
Yep, you're
Yeah.
right. These are the numbers thrown. I'm still waiting to see which one of them actually get into in becomes reality. All right. Shall we ask Fidelity? Okay, I'm just checking if I missed any questions. Okay, so I got Ryder 6 billion. CEO is Robert Sanchez, received stocks as a part of ESPP and sold a few. Okay. All right. So we'll bring up Ryder next week. I'll bring up the numbers. Naresh, you have to give me the story behind what keeps you interested in Ryder. I don't own the stock. I don't think I ever looked at Ryder. So it'll be interesting for me as well to know more about Ryder. All right. Okay. So today I have a little lighter agenda. Largely because I was traveling for 3 days, and yeah, I left on Monday, came back on Thursday afternoon, so did not have too much time to prep up. So apologies for that, but I'll try to do my best. Hopefully, some of the content will be, uh, some of them will be refresher. Most of them will be entirely new, and let's try to learn today. Other thing, which new thing, probably I don't think I've done it here before, is try to compare various stocks. So what recently I've tried to do is bring up, let's say if I'm thinking about a sector and I want to know, okay, in this sector, these are the 5 or the 6 companies that are being talked about. And I want to do that whole, that bird eye view analysis that I do on the numbers, but I want to look at each of them side by side to help me decide if I were to invest in this sector, which of these companies I should go for. So maybe we'll do that stock comparison. If you have a few companies in a sector that you want to compare for, do let me know and we'll do that quick comparison. But I think I have done for a few sectors, so maybe I'll share that with you guys. All right. Okay, so with that, let's get going, guys. Let's get going. All right. Before we start on our discussion, as always, everything that we discuss here is only for education, not an investment advice. Maybe a little bit fun. So don't go and follow anything that I say here. I will come and tell you what did I buy or sell, but that's not a recommendation. That I just want to be a little transparent in terms of what I am doing in my portfolio. I'll leave it up to you. What do you want to do, right? Okay, so we talked about the markets are not been great this year, at least so far. So it pays well to go back and look into, I think, this chart that maybe we have reviewed this a year ago, but I think it doesn't harm to go and look at it again in terms of different type of investors and how the results pan out to be. Okay. So this chart talks about five types of investors. One is Mr. Perfect Timing, which I am not. I don't think anyone is. He always invests $2,000 perfectly at a 52-week low every single year. So basically, there's a profile of five investors. They invest $2,000 every year for 20 years. So that makes total $40,000 over 20 years, right? One is Perfect Timer. She is Miss Lump Sum Strategy. Whenever she gets the money, she'll invest $2,000. Hey, I got a bonus. I'm going to invest $2,000. I don't care where the market is. Mrs. Dollar Cost Averaging, which is what generally, all the advisors will talk about it. Maybe you should just do a dollar cost, right? DCA. I'm going to invest 2,000 divided by 12 every month, right? So that if the market is high, I buy less. If the market is low, I buy more of the market. Mr. Unfortunate Timing. Okay. This is what happens. When you buy the stock, you buy at the peak and then the stock goes down, right? Happens. It's life. No one can predict the market. And this is Mrs. Safety First. I want return of capital. That's my prime motive. Return on capital. It's okay if I don't get it, but I buy return of capital. So the results after 20 years of investing, and the study had used 76 20-year rolling period, right? From 1926 to 1945, 1927 to 1946, 1928 to 1947. So you have from 1926 to at 76 years to, right? 2022, whatever that number turns out to be. And in 66 out of those 76 period, this was the ranking. Perfect timing, right? You bought at the bottom every time. When you were investing for the year, you invested when the market was at the bottom. No one can do that. And then the invest immediately, right? Lump sum investor, dollar cost averaging, worst possible timing, and then the T-bills. Even if you are the worst possible timer when it comes to investing, right? Maybe I invested all my money on February 19th when the market was at the peak. You still have done way, way better than just holding in cash or investing in T-bills. Maybe for 1 year we have not, but we're talking about 20-year period. Okay. So given enough time, and of course, this is talking about investing in the overall market, which is S&P 500, right? If you picked up a meme stock, the result could be very much different, right? You better staying in a T-bills than in a meme stock, right? But if you invest in a growing economy, in the companies or in the businesses that we use, those are strong businesses. Those are the companies that define, America's economy. You'll do fine. Right? We don't have to wait for, let me find whether I should invest now or later. If you have a money that you don't need it for next 20 years, right, invest it. Right? Worst come worst, right? You'll be, what, the 40,000 became 112,000. The best scenario is 138,000. The worst becomes if you don't do anything, right? Sitting in a T-bills. But I am aware of some folks, not even in T-bills, it's sitting in a checking account. That's even worse. It pays you nothing. So if we are feeling jittery about, my God, the markets are so down, maybe it'll go further down. I don't know. The tariffs are coming up. What could happen? Are we going to get into recession? Are we going to, I'm going to talk about some of those charts and the numbers. And this is what the fear currently is in the market is. Stagflation, recession, R word, S word, all the bad words being thrown around on all the financial channels. You hear about it from economists. Might be thinking, what should I do here? Right? Guys, if you have a 20-year time horizon, then why are we even waiting for like difference between 138 and 112? Right? It's the timing that matters, right? Not really well when did you buy it. So even the bad timing still works very so well just because we have a longer time horizon. So obsessing over the market timing is futile. Right? That's what they say. Time in the market is more important than timing the market. Right? If we are still waiting, imagine we wanted to invest in 2023, did not, and the market went up. Now we're waiting for the market to come back down so that you can invest in. We already lost 60% in last 2 years, right? Lost means opportunity loss of 60% in last 2 years. So it's futile. Right? Just if you have a long-term investor, then even if you buy at the worst possible time, that you every year you buy at the market top, you would have still done fine. A couple of market means SPY, that is correct. Aditya, is there a source regarding who published the study? This is, and how were they compensated? This has come from Charles Schwab. So yes, there is little bit of basically tooting their own horn. But I have seen multiple studies related to this, right? You pick up a SPIVA study, that's probably tells you the same thing over a longer period of time. I mean, you just look at the chart of S&P 500, right? Forget about any studies. Just look at a chart of S&P 500 over a longer period of time. We never had any 20-year period where we have not made money. Any rolling 20-year period. Never in the history of S&P 500. And of course, there are 30% chance that the market will actually return negative any given year. Over 20-year period, so far, more than 100 years of the market, zero. Other interesting chart was swing trading. I know a lot of folks are swing traders in terms of, yeah, I'll sell it when it is high and then buy it back when it goes down. Here was another study from Oakmark funds. You start at 10K, then you sell at all-time high and move the cash into 3-month T-bill and reinvest when the market falls by 5%, 10%, 20%, right? This is what the swing trading is. Any swing traders here? This is what we want to do. Sell when the market go high and then buy it back when it comes down. That's exactly what the swing trading is. Now, this is how we would have done over a long period of time. So this is going from 73, let's say 1974 to first quarter of 2024. Right? The $10,000 would have become 2 million. Right? and selling at a new market highs and reinvesting in market declines, you're way down here. You're way down here. Right? It is because you don't have these many opportunities when the actual market goes down 10%, 20%. And let me tell you one other thing. When the market goes down 10%, 20%, we get cold feet. We will not even be able to invest. Now, this is just a study, right? That, let's say you have already handed everything to an algo. This is what your algo would have done. You would have still vastly underperformed the market with the best strategy, which is sell at all-time high and buy back when the market falls down 5%, 10%, 20%. Because you don't have, over a long period of time, market falls down faster, but very few times, and it goes up for more time, but at a slower pace. So you never get an opportunity to get back in the market, and you are just holding the cash which you invested in T-bills. So don't go out of the market. Third one from a bespoke premium. Buying at peak is also fine if you held it for a long enough, right? The time will heal. Again, talking about the same thing, that even if you bought at the peak, it's okay as long as you have a time on your side. So focus on how you can stay invested. And this is why, attracted me to using options. I use options, as you guys know, I use options not to, swing or hit for the fences, and not as a gambling chip or not buying out of the money calls. I use options to reduce risk on my portfolio so that I can stay longer in the market. I don't want to be, get scared or, sold out of the market. Right? So thought later if we should go back and revisit some of these studies given what is happening in the market. Hopefully, it will give you some, some sense of comfort. Things will be okay as long as you invested in good companies, or just S&P 500, which is, if you're not fan of following a company, if you don't like reading annual reports or a quarterly reports, then have no business in investing in those individual companies. Pick up ETF. I mean, we have so many options to invest. Not investing is just an excuse, I would say. All right, we'll jump into the market, but let me look at some other question. Ashwini say, I tried swing trading strategies in Google Sheet, was not able to beat DCA. Okay. Oh, so you only looked at, you try to just simulate it. I think with leveraged ETF in place, swing strategies with a mix of leveraged ETF can perform better than buy, hold, or DCA. I have my own issues around the leverage ETF. Leverage ETFs, you should not be holding more than a day because of how the ETFs are structured. I know a lot of folks get a lot of very interested in leveraged ETFs, but if the stock is volatile, then it is very difficult to make money over a long period of time on leveraged stuff. It is not for, you should never be inventorying the leverage stuff. Want to deal in leveraged ETF for a particular event, overnight risk, maybe 2 days risk, fine. Holding leveraged ETF for a stock, if it is a volatile stock, doesn't work out. Some cases might work out, right? But you're never sure. I've seen cases like Tesla that over a period of time, Tesla is up, but your leveraged ETF is actually down. Why? Because Tesla actually went through a drawdown period and it has been very volatile, as Tesla generally is. So you never know if I'm going to make money on some other period, you probably made money, right? But for some other period, you may not have made money. So I'm not a big fan of leveraged ETFs. You want to get a better capital usage of capital, there are other things that you can do. Maybe look into futures. Maybe look into using options, doing a stock substitution to have a better capital usage. I see a hand up. Who has their hand up?
Vivek,
Yeah, Shri, go ahead.
one of the things, can you go back to the one where he was perfect timing, and the second person was investing 2,000 every month?
No, this was a lump sum whenever you received it. So we don't know whenever you invest. It's like random.
So the total amount was 40,000
40,000.
over the 20 years. Is that what you were saying?
Correct.
Okay. The other question that I have, has anybody done a study based upon the total asset that they have and taking some profit when they reach a high level, small amount of profit, and invest the same amount when they go down by 5% or 10% or 20%, like what you have suggested, and their portfolio in comparison to the people who are holding the stock, and like the one that you're talking about, perfect timing and all the other ones. It's a combination of buy and hold and also a swing trading along with that.
At least I have not come across that study. But if anyone else have, feel free to pitch in.
That's the way that most people do, I guess, because you sell sometime, you buy some other ones, and that's how I manage my asset.
Yeah, I mean that's what I also do. I have some portfolio which I call my coffee can. Right? I'm not gonna touch it, come what may. And then anything above that, let's say if I own a Google, I'll say, okay, 100 shares is a coffee can portfolio. Top 50 shares could be different. And then on the 50 shares, I'll do whatever I need to do, right? But well, you're right. Most of us do that. We just can't sit idle. All right, Ashwini, go ahead.
So to answer Shri's question, Shri, I think the point you are asking is actually equivalent to timing the market, right? So selling when it's high and then waiting for a time for it to get low, it's essentially equivalent to timing. And the results that you're going to see will actually be equivalent to one of these underperformers cases, where they try to time the market. In fact, I did this as one of the back testing exercise using Google Sheet, and my results were actually poorer than DCA. But I didn't go way back in time. I just tried last 10 years data.
Ashwin, I'm not doing a market timing. I'm just saying take a portion of your portfolio out of the market when it has reached a high, and then try to reinvest when it goes down by 5%.
Exactly. Yes, that's what I'm saying. It's exactly equivalent to timing, right? What if it doesn't go by 5%?
Yeah. So
there are sufficient instances, or I can pinpoint. If you look at the graph, there are sufficient instances where you can see the market never actually goes below the high that it has made, right? And then the second question is, when do you exit, right? What if you exit too soon, right? And market goes 20% after that.
So maybe I think, Ashwin, if you say you have a Google Sheet where you can run the simulations, maybe if you can modify to say, I'm not gonna get out completely, maybe whatever 10% of your portfolio, which you sell when the market falls down 5%, and then see what the results are. I think that's the question that Shri has.
Yes, I that's what I did. So
okay. It's not like completely came out, but
correct. It's basically you are now timing that 10%, right? It's the result are going to be same. On that 10%, you will see inferior result, right? That's how it is.
Yeah.
Well, how do you manage your portfolio, Ashwin?
So I think this exercise that we are seeing, or the study that we are seeing, is primarily for the index-based investing, right? Don't confuse it with the individual stock based investing. Their results are very different. Their timing is actually essential part where we say the valuations do matter, right? So you don't want to enter Tesla, for example, at 450, right, when it is at peak, and assume that or hope that it will someday go to 900. I think this is mostly about
but this is about S&P 500.
Yes.
So this is even the right. This all is about S&P 500. Even the previous one is all about S&P 500. Right. Individual stocks is a completely different ball game.
Right. For me, I am actually 90% in individual stocks. So actually, large part of it doesn't apply for me. But I'm very interested in doing a mix of a regular ETF with the leveraged ETF, and that's where I ran some studies with the last few years of data. And I think with leveraged ETFs, the point that you're suggesting around exit when it's high and then enter when it's low, that gets actually very effective if you use leveraged ETF in your portfolio. So very simple rule that you can run is, for example, just do a 50-50 split of regular ETF with the leveraged ETF. Just pick 50% QQQ, 50% TQQ, right? And then at any point when TQQ allocation becomes, let's say, 2x of QQQ, you trim TQQ and shift it to QQQ. Right? If you keep doing that, it actually performs better. And that's what I tested for last 10 years of data. It performs better than simple buy and hold or even DCA strategy where you just buy TQQ at whatever price or just buy at the beginning and hold it.
Can you also add the impact of your capital gains into it, tax into it?
So, okay. So that I didn't include that because I was assuming I'm just doing it on 401k.
Okay.
Because anyways, I don't have much hope of getting that money back. So I should just, scratch my itch as you call it.
Okay. Yeah, because the other thing which we need to worry about or especially if you're doing in your taxable account is impact of taxes, because the moment the taxes get taken away, now you're left with 30% or whatever the less money to invest again when the market goes up. So
one other point that I want to mention, the total portfolio, if you are using the total portfolio to invest in the market, some people consider 30% to be in the stocks and the other 30% or 30 to 50% in options only, like a strangle or vertical or iron condor and all of those things, and another 30% to invest in sort of futures. And that has performed well in their situation. And I'm trying to institute that in my portfolio. Options is, like you're trying to buy it when it is down, and when it is high, you're trying to get rid of your shares at a higher price. That's one way of swing trading in a way. That is how it works out.
yeah. So I mean, I do the same stuff, but I don't segregate my portfolio saying this much is on the stock, this much is on options, this much on futures. My way of looking at is, like I shared in terms of the portfolio construction. Mine is, I want to have a 50-60% in core, either the ETFs or the big solid cash flow generating companies. 30% will be growth companies, those high flyers may not make money right now, but at least they have a product market fit. And they have been growing crazy. So reinvesting everything, and Hon's not profitable currently, may not be even cash flow positive. And then another max 10% will be, which you call as a rocket shapes or the moonshots. Some of them may not even have a product right now, right? So I think that's how I will allocate build my portfolio, and then against each one of them, especially around the core one and the growth one, I have a bunch of stocks. I hold the stocks, which I call as my coffee can portfolio, coffee can portion, and then on top of it, I'll do options around it, right? Or just to reduce the cost basis and to generate the cash flow. But that's what I do. Yeah, but I'm aware there are other people who will talk about, okay, this is my stock portfolio, this is my option portfolio. I don't segregate between stock and option portfolio, because at the end of the day, for me, even the option trade will eventually result into the deltas. So I'll say, okay, I have a 5 positive deltas, and maybe if I have 100 stocks and 5 positive deltas, overall it's 105 stocks. So, but that's just me. But everyone is a different. Maybe someone else manage their portfolio in a different way, can share.
Yeah, Vivek, the portfolio. Hold on one second. Let me think it over again. The studies that you're representing is based upon the S&P 500, which is the market as such.
Correct.
But people don't invest all of their money in the S&P 500. If they do invest, they're basically doing the average of whatever the S&P 500 is doing. If you're trying to increase your returns more than the S&P 500, you have to do other things like choosing the best stock in the market, and hopefully it will continue to go much more than what S&P 500 does. And that way you're making much higher return on the stock that you have chosen. But not all the stocks will go along with the S&P 500 in a uniform fashion. So you need to make a decision when is the time to get out of the S&P 500 or the stocks, individual stocks, and get back into S&P 500.
So,
Your thoughts on that?
So Shri, my at least motive and hope is people who come and attend this at least invest in S&P 500. I'll be much happier. What you're asking is at a much higher level. I met people who don't even invest at all, right? So maybe a few of the folks that in our circle, because you invest annually, say, oh, come on, what is S&P 500 worth? I want to have more about it. I'm like, even if someone invests in S&P 500, great, get started somewhere. And since you brought about in terms of trying to beat the market, there's another study. I actually had a big research paper I've yet to read, but there is a summary which was again, it was shown up in I think in Barron's, around why it is so difficult to beat the market. Market is S&P 500. Right? I know you, me, we all are trying to do all this stuff, and I'm well aware of it, trying to beat the market. But I'm also aware it is very, very difficult to beat the market. More than 57% of the stocks. Now, we are talking about over 125 years of investment history across 21 countries. More than 50% of the stocks underperform T-bills. If you talk about individual stocks, almost all gains of the stock market, this is from the US side. I can actually maybe pick up the PDF, can be attributed just to 4% of the stocks. Now, what's the probability that I will be able to buy those 4% of the stocks over the past century? If you don't own them, you can't beat the market. Right? And I think this came in maybe Barron's most recently. Stocks are great, but not most of them. US stocks return on an average 10%, like 9.7% over the past century. And they have been the best asset class across 21 countries, which have more than 100-year data around investment. Right? But still, more than half of them couldn't even outperform T-bills. So I'm not even suggesting anyone to go and find the best stock. Get started on S&P 500 at least. Because it's very difficult to beat the stock or the index over the long term. And yeah, so this is why it's very difficult. I mean, we are trying to add all these things, which is great. But I mean, if there are folks, sometimes you might get lucky. If I had all my portfolio in NVIDIA, that would have been great. Right? But overall, that's why, I mean, there's studies out of studies, most of the hedge funds or the money managers, more than 80% or 90% of them, they just can't beat S&P 500.
Again, the NVIDIA, you're talking about it because it has gone up significantly.
Exactly.
You can consider also the same way as Tesla. Tesla had gone up significantly and it has come down to 50% from the highest level that it had reached. So NVIDIA is probably going to be down more than 30% and more than 50%, maybe in the next couple of years from the high point. Yeah. I'm not saying it is not a good company, but you need to take into consideration when is it time for you to take the profit. Yeah. And the other point that I want to make is everybody who is in the investment business or investment, if you have an idea of investing, compare yourself to the S&P 500. the beginning of the year, end of the year, or on a monthly basis, take into consideration what the S&P 500 has done and what your stocks or your portfolio has done altogether, whether it is in cash, some of it in cash, some of it in the market or in individual stock or mutual fund, whatever it is. Compare yourself to the S&P 500. And
After fee.
the
I would want
index,
after fee because mutual funds will charge a fee. Compare results after fee.
no, but your portfolio will reflect all the fees and everything
Yeah.
after that. But again, the other point I was trying to make is why not buy the stocks that have gone down by 50% and then wait for it to reach a new high? And when it comes down by 3%, 5%, get out of it if you want to. Again, it is difficult to beat the S&P 500. And all the indexes are not the same. S&P 500 is a peculiar index. NASDAQ index is entirely different one. NASDAQ has outbeaten the S&P 500 on a longer time period. Russell has outbeaten the S&P 500 on the longer term. So you have to decide which one is the best one to invest in.
So I just want to caution on this one. Along with the higher performance of both NASDAQ and Russell comes a higher volatility. Consider the fact in 2000, if you were completely on NASDAQ, would you still stay invested if the index had fallen by 80%? You have to go through those swings and the big volatility to get that outperformance. My worry is people get into high performing stocks or high performance indexes without understanding the volatility that might come along with it. And when the volatility comes along, they're like, okay, I'm done with it. I'm out. And then you can't get that extra performance because you're already out of the market. So figure out what kind of investor you are. S&P, because it is less volatile and it represents much bigger part of the market or the economy. That's why it's been mostly being talked about, and that's why most of the studies are based on S&P 500. But yeah, there are other indices which have done better with S&P, or the individual stocks that have done better with S&P. But then we must also understand what's the price that you have to pay. I mean, we are already paying the price of investing in the market based on what we are seeing last 3 months, right? The price of volatility. Volatility is the price that we are paying to get a returns from the market. So I'll not be angry on anyone who say I just want to do an S&P 500 and sit back and enjoy. Yeah, that's one of the best strategies that someone can do it. In order to try to do it or make it more complicated and then get scared because my God, my stocks are down 40%. In 2022, QQQ was down 40%. S&P was down 18%, I guess. And at that point of a time, if I thought, I'm done with QQQ because, dude, 40%, and whereas my other friends are down only 18%. And if you have moved out of the tech, then you would miss out on all the gains that those tech companies have done. I think maybe the QQ probably is up 100%. Since October 2022.
Since you brought this volatility issue, I want to point out a few things. As I'm a contrarian, whenever somebody says that this is the best time to buy, I'm usually trying to short it or sell some calls and willing to take a short positions in that one. The best time to buy the NASDAQ or the QQQ was when it was down 40% in comparison to the S&P 500. So that's the type of personality that I have. And I have outbeaten the S&P 500 over several years since I started keeping track of the data.
Yeah, I mean, which is great. You understand yourself and you have trained yourself to buy when the others are fleeing the market. Most of the investors are herd investors. I mean, I've been training myself to buy on a red day and maybe sell on a gray, but don't sell on a red day. That's what I'm training myself to. Let's not sell when the day is red. Anyway, let's look at the market overall. in terms of what's been happening. From our administration side, there are two things that we have been concerned, market has been concerned about: tariff and the trade policy. So April 2nd, next week, we have a reciprocal tariff announcement. We might get some clarity. I don't know. With this administration, nothing is clear. Are we going to have tax? Or we not going to have tax? We don't know. What the scope will be? We don't know. Which, whether it will be like blanket reciprocal tax, whether it will be to specific industries. We have no idea. How much will be the magnitude? Will there be some respite for some countries? We don't know. When will it happen? We have no idea. How long will it stay? We have no idea. So everything is up in air right now when it comes to the tariffs. And one thing which market hates the most is uncertainty. Right? You tell me that you're gonna charge me 20% and stick to it. As a CEO and a CFO, will manage our business. But you tell us what you're gonna do. The problem is when the administration keep changing, we don't know what are we gonna enter into. We saw the same stuff in 2022 when the rates went higher. Yeah, initially companies performance was bad, but then we'll get adjusted to a higher interest rate environment. Some of the companies that could not, they've fallen by the wayside. Great companies, will find, will again, they started to increase their profits and everything else. So it's only the startup problem or the initial days when the change is happening. Once you know the change and it is in place, I think then it's a steady state again. Today, right now, the problem is we don't even know what is that administration is going to do. Right? Will the tariff be country by country basis? Will it include other non-tariff stuff like VAT, etc.? Right now, everything is in the mix. Hopefully, on April 2nd, we may get some clarification. Some new tariffs came in: 25% tariff on all auto not made in US. This will take place on April 3rd, and it will target fully assembled vehicles, but will expand to include the auto parts by May 3rd. So in two phases, right? So GM and Ford, they got screwed. Tesla stock was up because Tesla doesn't import that many as their competitors do. So it's better for Tesla. Given that about half of 16 million cars were imported, the sector will experience some disruption. There may be some knock-on effects, the higher prices for the used cars, costly repairs, maybe insurance. The car, maybe the used car company stocks probably have gone high based on this. Maybe the companies that sell car parts, or O'Reilly, AutoZones, Auto Parts, those stocks probably have gone high because now if the new cars are gonna be expensive, the consumers will be holding on to the existing cars for longer, and then they will need to do more maintenance and all that stuff. So this is the US auto imports breakdown by this country of origin: Mexico, Japan, South Korea, Canada, Germany. Others are like 7%. So maximum impact when I look at North America will be Mexico and Canada, right? And that's why there's been back and forth between the leaders of these two countries and our leader in terms of what they're gonna do. Separately, the new administration suggested that additional product-specific tariffs would be coming soon, which is around lumber and pharma. So a lot of stuff about discussions and the news around the new stuff, new tariffs, right? Other stuff is I did not know until I read through this that there is something called Economic Policy Uncertainty Index, right? What the heck is that? Then when I read through it, this is called 3-month average of economic policy uncertainty, which is basically they scan through the financial articles, and for the word called economic uncertainty. And then they plot in terms of how many times has the word been found. So now economic uncertainty has appeared almost at the COVID high. When we did not know that the world is about to shut down, probably the world was already shut down. We had no idea when we're going to open up. We have no idea whether, whether we will be able to live, will we be alive next year or not. Right now, that the same level of uncertainty we are seeing in the markets. But is the situation that bad? Probably not. But market doesn't like uncertainty. And now I think the Q2 results will start, Q1 of 2025, the results will start to come up maybe in a month or so. And it will be interesting to see how many CEOs and CFOs come back and talk about uncertainty, right? Maybe I personally think many of them should just withdraw their guidance saying, we don't know. If we don't get full clarity in April, then on what basis are you gonna give me any guidance for the next quarter or for this year? If you don't even know what's the amount of tariff, how long, all the stuff that we have discussed. But I suspect maybe some of them will either withdraw the guidance or change the guidance or probably put a rider on saying, hey, whatever we told you at the end of 2024, add 5-10%, error margin into it. That won't be out of ordinary because there's so much of uncertainty. Yeah, markets don't like uncertainty. Situation is bad. Just tell me this is going to be bad. Just don't keep it suspense on what the current status is, which is currently what's happening with the administration. Right. The other thing that we saw is a 5-year look at inflation came out to be worse than expected. So basically, I think there's a survey that is being done of consumers, and this tells, what do you expect 5 years later is what's going to happen? Because based on that expectation, consumers also change their spending habits, right? And if you think that the things are going to be way more expensive and your salary is not going to catch up to that, you might want to save more and spend less right now. So anyway, so the whole idea was that the inflation expectations rose over 3-decade high. Last time we saw that was in 1993. So, and sometimes this inflation stuff, etc., could also be self-fulfilling. Right. Looking at the other way, if I'm assuming that, the thing's going to be more expensive next year, if I have money right now, I'm not, especially those who are in let's say, a middle income strata or higher, maybe I'll buy today. So this inflation could also is a self-fulfilling prophecy. If you think that the inflation is going to go high, probably we will push the economy in a way that it actually becomes high. So that's a little bit concerning that the expectations, 5-year consumer inflation expectation has rolled over 3 decades high. Consumer sentiments in the March, so this is like Michigan, University of Michigan, they do the study every month. Consumer sentiment index was revised down to 57 from 64.7 in February. Consumer is not feeling that great. And US economy, I think 60 or 70% of our economy is all based on consumer spending. And if you're not feeling great, you don't want to spend, and that means we might be looking at the R word. So labor market concerns also start to rise a little bit, even though it is still strong, but 2/3 of the respondents now expect unemployment to increase next year, and which is the highest level since 2009. Means 2/3 is the highest level. Not that the unemployment will be highest since 2009, but 2/3 respondents, 66% of respondents say, I think unemployment going to be higher next year, which is the maximum number of people that have expressed their concern about unemployment. Right? And for a consumer-based economy, resilient labor market and steady income If you don't have that, then you'll not be spending that much. On an aggregate, if you have a lower, if I'm not sure about my income, and if fewer people are getting employed, then the overall spending, consumer spending will be low. And that's not good for our market. So the net result is weaker economic growth due to tariffs. This is the forecast, right? Nothing is in place yet. These all are surveys. What do you think will happen? Tariffs, this is assuming that this is going to happen on tariff. We don't know. It's an uncertainty, right? So there's all is potential, crystal gazing. Potential increase in inflation. That's what the consumers think. Sinking consumer sentiment and potential concerns in labor market. Add these two, weaker economic growth plus rising inflation. That is what the stagflation is, which is like the worst of both sides. You don't want to have that. No economist, no one in, let's say, administration would want to have stagflation. And 3 plus 4 is basically our consumption-driven economy going downhill. So which is what spooked the markets on Friday around, I don't know. My God, we have a very bad future coming in because of these reasons. And since our economy mostly consumption-driven, it hurts us more. So this is all based on what we expect is going to happen. I don't have a crystal ball. You don't have crystal ball. No one has crystal ball. No one has been able to predict what's going to happen. So let's focus on what the reality would be. Because of this, we saw S&P was down 2% on Friday. QQQ was down 2.63% on Friday. Russell, which is a Russell ETF, IWM was down 2% on Friday. Year to date, S&P is down 5.19%, 5.2%. QQQ is down 8.27%. We were talking about volatility. Right? QQQ has outperformed, but it comes with a cost. Right? Now it is down almost like more than, even on the downside, you have the swings which are more than 50% more than what the S&P 500 has. Right? So market is all sold off on our projection of what might happen in future. Right? This is all our future stuff. What's the reality? Corporate profits are still rising. Remember we were talking about the start of the year, our estimate, the Wall Street, the consensus estimate was the S&P 500, we're looking at close to 14 to 15% growth in earnings. Now those earnings the expectations have been tapered. Now we're only talking about 10% growth, but we're still talking about growth in earnings. We're still talking about growth, right? We're not saying we're going to get into losses or stagflation. Maybe in Q2, companies might come back and say, no, we're not going to grow. We'll see it then. But right now, we're still talking about 10% growth. Unemployment, future, we might expect that it's going to be bad, but still current reality is still at a historical low. Private sector continue to add the jobs at a nice, healthy pace. Now, DOGE might bring in more unemployment in the federal sector, but federal employees account only for 2% of total employment. Third, Fed is taking wait and see approach. Fed has not come back, so okay, inflation is going to go high, I'm going to become hawkish. They're still, and they have not changed their projections. Fed has told 2 rate cuts this year. They're still holding on to these rate cuts. And this time, changing the policy to be more restrictive, the bar is really high. They're not gonna, become hawkish maybe just by 1 reading. Right? So currently they're still projecting 2 rate cuts. Fourth one, so far we've only talked about the tariffs. The other side of the stuff, which Trump has already talked about during his election campaign, is around tax cut, the continuation of the tax cut, deregulation. Those are yet to pan out. Finally, generally it is said that the bond market investors are much smarter than the stock market. Bond market tells you what's going to happen in stock market. Bond market is a leading indicator of, if you know how to read the bond market well, on the it will tell you what's going to happen in the stock market. Many smart people actually trade more in bond market, which is much bigger market than the equity market. And the bond market is not thinking that the companies are in distress. The spread, credit spread, which is how much is the bond market demanding from the companies that are not investment worthy, how much additional yield are they demanding on top of risk free, they're still narrow. So the bond market investor, they're not thinking that the company is going to go out of business or the companies will have a tough time. Not yet. So all these are still positive stuff. So if you only look at what we are seeing in the markets or trying to look at all about projections, you might think that the situation is very bad. But there are other stuff which is on the reality of what's actually happening. I don't think that the situation is that bad yet. So I'm going to stay invested, stay diversified. I think that's important because there will be some sectors that will get impacted more than the others when it comes to tariff. And that is why if you want to pick individual companies or individual sectors, you have to put in a lot more efforts to find out which one we should pick up. And, I don't know all stuff. No one knows everything. Then you got to spend a lot more time. But if you stay diversified, that is why I'm a big fan of S&P 500. It'll give you more of what is working. But it is painful. We start a discussion saying, oh, markets are down. I think Morris brought up. Market has not been good for 1 month. They haven't been good for the whole year. But guys, this is what we get paid. You don't deserve 20% return and 22 and 24% return, capital appreciation if you can't face the drawdown of 30% at least. So I'm gonna stay invested. I don't think that situation is, at least I don't know about future, but current situation doesn't seem to be as bad as what the market is pricing in to be. Individual companies, forget about that. I don't want to talk about individual companies right now because there are many other factors that drive the individual companies. When you look at an overall, I think I'm still fine. So I'm gonna stay invested, reduce cost basis, try to hedge if you want to, but not willing to pull out just for the fact that the market has gone down. I might pull out money for some other reasons, but not for the fact that the market is down. I think I need to move into cash. So that's, I thought I'll share with you. It's not that bad. There are good things also, and we don't know what's going to happen in future. I don't think anyone knows what's going to happen in future. Right? But this is the price. This is the price we have to pay. This is the ticket for enjoying the gains. This is the ticket that we looked at wherever to get this stuff. Nothing is free. Nothing is free in the markets. One thing is very clear. Either you pay by dollar amount or you pay by increasing your heartbeat. It's okay. You need to understand what kind of investor you are. And if you can't go through the volatility, T-bills is still fine. It's still giving you 4% plus. Nothing harm in that. I think I have an article in terms of if you have $1 million, how you can generate 49K per year investing in tips, which is again inflation protected. And if you're happy with that, go for it. Just don't go for the stocks if you are not mentally built for going through the volatility. So rather than trying to know which is the right stock, I think more important is to understand what kind of an investor you are. There are a lot of great stocks or not just stocks. There is a lot of instruments for investing. The mistake that we do is try to copy others without understanding who am I, what kind of investor am I. I think most of us, we should spend a lot more time in understanding ourselves as an investor. Or then there are lot more opportunity. You tell me, okay, I'm this type. I want to have a very safe fixed income. Yeah, there are dividend ETFs. Invest in the bonds. Invest in T-bills. Understand yourself more when you need money, etc. Then the opportunity. There are different ways you can invest in. Anyway, looking at the sector wise, right? We're still looking at or energy still done great. Remember last year, energy, healthcare, and I think the real estate, these were the worst performing sectors in 2024. This year, the script has flipped. Last year, tech and the consumer discretionary were high. Now the script has flipped. So if you bought in tech last year and now you're sitting at 10 or 11% down, I mean, that's what you need to understand. If you're buying on a specific sector or a company, the risks are very different. Fear and greed index. I mean, these are a few stuff that we look at every week. Market swung back to extreme fear. Last week it was in fear mode. I think 2 or 3 weeks ago it was in extreme fear. I think until this uncertainty, as long as this uncertainty is there, I think we'll keep flip-flopping between extreme fear and fear. This is another reason why I'm not willing to sell anything. Maybe if you have a capital around, I actually bought, right? If you have a capital to invest, this is the time to invest when everyone is fleeing the market. You can get the stuff on discount. And it's time to be cautious when it swings to greed and extreme greed side. And we've been noticing this for 4 5 years. It's always happened. Market becomes extremely pessimistic, and then it'll become exuberant, and then we'll correct it. It keeps swinging, right? We have seen this happening over and over and over and over again. So that's on the overall market side. Let me see if there are any questions. I was hit by NVIDIA. Because NVIDIA is okay. It is a volatile stock. NVIDIA is one which stock has done great for the last 3 years, but can't say the same over the last 1 year, right? If you look at NVIDIA, it's been a wonderful, wonderful stock to own, but not over, let's say, now NVIDIA is here, right? It's back up to where it was, like since September. I haven't done much for the last 6 months. Back to where it was. But if you're investing in a stock, have at least 5-year time horizon. Don't even think about it where the stock has gone, before it is 5 years. Okay. So is NVIDIA down? Yeah, sure. But NVIDIA is at a much better valuation. Valuation-wise is much better right now here than when it was here at $20 or $15. Just based on in terms of what their projected revenue growth is. It's become a much better company. But yeah, a lot of stuff could be, when everything is in AI, things get hyped up. That reminds me, yesterday, it was for the first time, I actually went to a startup pitch event yesterday evening. It was almost like including initial networking and then the mixer after the pitches. It's almost 3-hour long event. And there were 10 pitches. Out of 10 pitches, I would say 8 were all related to AI. We do this marketing campaign to help you in building your brand using AI. Right? This is an education. One was an edtech company helping people, the kids learn it faster using AI. Almost all of them were kind of the tried and tested business models. Nothing new, nothing exciting, but everything added on AI. So is AI hyped up? Yeah, in some cases, yes. And I'm sure Most of them are not gonna make it. I wish them well, but please understand, just by slapping AI, you're not gonna change the business model. Just because you created an app that uses AI, one can create an app from Manus.ai, right? That's I think a Chinese company. You just feed them with your requirements. I think the days are gone when you can come and talk about, hey, I've created this app. There is zero value in that development work or that engineering effort that someone has put in just to create your app. Nowadays, there are systems that will do it for you. Anyway, so I'm not surprised that everyone is only talking about AI. Founders are still focused on AI. And the last week we talked about delusions of a big market, right? How it is an individual rationality and collective delusion. Same stuff probably will happen in AI. I don't know when this is gonna correct. Someday the correction will come. We'll deal with it. Right. So anyway, Maurice, how is the fear and greed calculated? Maurice, there are 7 factors that goes in it. Just search for fear and greed, CNN. So on their page, they have listed, I think there are 7 factors that they take into account, which is what's the breadth of the market, what's the positioning by the market participants, how fast, etc. Yeah, there are 7 factors. All right, looks like we don't have data. So I'll skip this. I waited for 2 weeks. It didn't come back. We could have done the story and the numbers play with the hims and hers, but I'll move on. The Dave is not here. So what's the buys and sells this week? I became owner of Google. I did not realize that this was April 17th short put I had. I should have rolled it forward because the extrinsic value was almost zero. I did not do it, so I got assigned. I'm holding the shares. Same case with the Jumia Tech. I short put was there, which got assigned. Now this has reached my full position, so I'm not be adding anymore to this ticker. Alibaba, I bought Alibaba shares just to refill the tank. You know, like Shri and I, we were talking about it. I have my core portfolio, then on the top of it, I'll play options, try to generate cash flow or income, or trying to buy it at lower than the market price, etc. So back in March, I had a cover call spread that was in the money. And maybe if you go back and look at March, whatever the weekend after this was, Saturday after this, I would have told you that I had to sell some Baba because of the covered call spread was in the money. And now this week I refilled it. Just refill the tank. Again, I'll basically do options against it. So nothing specific other than the Baba other assignments, or because I had a short puts on it. Okay. Don't go and buy Google now because, hey, Vivek bought it. My portfolio is different. My situation is different. And the way I look at Google may be very different than what you may want to look at, right? So, but I want to be transparent in terms of what I bought or sold. Some other headlines to look at, or maybe what do we want to do? Do you want to go to some stock comparisons where we compare some stocks side by side of different sectors, or shall look at some more charts, etc.? I see a question. Is it time to add NVIDIA/PLT? I guess /PLT is you're looking at Palantir. It should be PLTR, or is it PLT? Is there anything called PLT? I don't know. PLTR, I'm aware of. PLT. Plantronics. Is it still wasn't it bought over? Okay, it's Palantir. I think Plantronics was bought over by what, HP or some other company? Okay, PLTR. So Palantir is at much cheaper valuation than where it was definitely a few months ago, but I'm not buying it yet. I mean, from my perspective, it is still expensive, not as egregiously expensive as it was at 125, right? But it's not a well achieved valuation. But if you don't, so I already own Palantir, right? So I'm not gonna add more to it right now. But if you have never owned Palantir, you want to DCA into it, sure. It is now available at 40% less price than what it was a few months ago. Right? So, but I'm not, I think I have a short put at 70 and I have a cover call at 100. I have like a strangle on it. I have a couple of option trades on Palantir, but I'm not buying right now. 70 maybe, right? Because it's still expensive on 70, but it's not, at least not egregiously expensive. I love the business, but I just don't like the stock at this price. Niyanka says stock comparison. Okay. European defense stocks. Yeah, if you understand Europe, if you understand those companies, sure. I know Rheinmetall has done really great. Again, European defense stocks have only risen in, let's say, this year because the EU has now, have decided to increase their spend because new administration saying, you take care of your problems in Ukraine. Why should US always be spending? So yes, they have a current tailwind behind European defense stock, Rheinmetall, BAE. I think there are a few others. I forgot the names of it. I thought maybe I've shared a chart earlier about some of those European defense stocks. But again, the question is, if you're investing on the current thesis of EU spending more for their own defenses, what happens when the US administration say, yeah, you reduce tariff or the taxes on US side will pay you more money or will help you in your own defenses? What happened to those stocks? So I am not if you have looked at those companies and you think those are the great companies to buy for every season, sure. I am not just big fan of investing in only for this event, which is again could be uncertain based on what governments may decide to do. These stocks have performed great, and that's why they are attracting so much of an attention because they have outperformed S&P 500 by double digits for this year. The question is, if I want to hold the stocks and I want to invest my time and energy, I want to hold it for next 5 years. I don't have a capability to figure out what this company is going to do next 5 years. So yeah, if you think that this whole geopolitics is out of my expertise, but if you think that EU will spend more on their defense, I mean Germany has mentioned, and that's why the Germany stock market has boom has gone higher, then yeah, sure. But otherwise, EU mostly have had old economy industrial companies, very few new tech companies. That's why the EU has not been great investing opportunity over past many years. This year, because of this whole defense spending, some of the EU stocks have started to perform. What is your case for Google? Still, it's a good cash flowing company. Search engine which was predicted to be eaten away by the chat GPTs and the LLMs. Haven't seen the evidence of it. Yeah, sure, it probably might have come down, but it's still 80% of the search engine. Last quarter we looked at the overall revenue, still up, right? Search engine revenue is still up. YouTube is a dark horse. YouTube itself is what, $10 billion per quarter business. And this is one of those Max 7s which is available at 18 times earnings, which is even cheaper than the market. I don't know. Let's look at it. Is it still 18? There are the risk is around this whole government intervention in terms of trying to break Google. That's a big risk. It's 19 times earning. Forward P is like forward is even 17, which is much cheaper than the overall market. So I'm not willing to write Google off. Then you got a moonshot of Waymo in it. Waymo has now started in more areas on a Bay Area, and then I think there was a recent announcement that they're going to start driverless ride in Washington or some other state. So Waymo is expanding. So that's why at this price point, I was bullish on Google and I was okay to buy Google and hold it in my portfolio. Again, other thing that we should be aware of, stock could be great. What we need to focus on, what's my position size? And I have decided that I will not let any individual stock be more than 15%. Right now, I don't have anyone more than, I think the biggest one is Mercado Libre, which is maybe 6.5%, right? I'm way far away from having any individual stock be a 15%. With all these positive points on Google, it could be horrible or wrong. Maybe government will say, Apple cannot give $20 billion, Google's dominance on iPhone as a search engine will no longer be there. Google should be split up. And then maybe no one is going to search because everyone is on Perplexity asking questions. Sure, but then I'll control that risk by making sure that the Google as an individual stock is only a certain percent of my portfolio. I don't control future. I can only control what I own and in what quantity do I own. So that's all I can control. All right. How about ARM? I've not owned ARM. I've not looked at ARM. Maybe let's. ARM doesn't have too much of a history. Only 2 years of history in public market? Let's do stock comparison. Niyanka says comparison. All right. Let me see if there is anything other interesting chart that I wanted to share. Oh, let's finish our Coreweave and be done with Coreweave, right? So last week, I reviewed the S1 with you guys and told you I'm not touching it because of blah, blah, blah. We had all those list of reasons. This week, they actually lower their IPO price. Right? Earlier, if you recall, I think it was between 44 and 50 something. I think that the mid price was 49. Now they actually had to IPO at $40 because market was not willing to pay for 49. Right? Now the current market cap is close to $20 billion. I think earlier we were planning to raise it at $30 billion. Thank God some sense has prevailed in the market. I still hold my viewpoint that it is a stock, it's a risky stock with a bad business fundamentals. I don't care that it is an AI. I don't care that JP Morgan and Goldman Sachs are telling their high net worth client why they should be in it. It is dependent only on one supplier, which is NVIDIA. It is dependent only on one big customer, which is Microsoft. I think 62%. What was in their S1? We looked at last week in terms of, let me go back and maybe revisit the risks that we had looked at, right? Coreweave. Where we had, this is the financials, accounting irregularities. Yeah, so Microsoft, okay, 77%. Yeah, Microsoft is 62% of the revenue. Right? Microsoft catches cold, and this is what happened last week, that Microsoft, there was some concerns that Microsoft may not spend as much on the data center as what they probably were thinking to spend, and then the Coreweave crashed. Right? You don't want to be investing in a business. And when I'm looking at it, I'm like, for next 5-6 years, can I invest in a company which is dependent only on one big customer? And what are they selling? A depreciating asset. Right? So when it comes to account, imagine the amount of depreciation that we may have to take. Right? NVIDIA is coming up with a newer chip. And if you come up with a newer chip, the value of your older chip will go down. Right? And finally, founders have no skin in the game, very less skin in the game, only 3% of financial interest in the company. They sold out most of their financial interest in 2023 and 2024. Right? I don't want to be with the management with the skin in the game, without the skin in the game. They have 80% of controlling right because of a super voting shares, but only 3% of financial interest. Right? So I'm still not touching it. Where did it end up? It opened at 40 CRWV. Oh, it's closed at 40. Is that right? Anyone bought CRWV? Coreweave? It's okay. No shame. Okay, maybe it closed at 40, exactly 40 where they had IPO'd it. So, and you know, a lot of other stuff that we looked at, bean counters, none of them have all the founders are hedge fund guys. Nothing against them, but then be in a hedge fund business, right? Don't be in a business of managing a data center. So a lot of cringe feelings while going through the Coreweave S1. So I'll stay away. For fun, yeah, maybe you can. iPhone says I bought one share. Yeah, for fun, or maybe I think it's a good strategy to buy one share or maybe 5-10 shares, depending on your portfolio size, to keep it on radar. Right? And wait and see how this company performs. I won't say never. I think in investing we should not use word never. I won't say never buy it. Maybe if Coreweave is
Hey, attend the class.
trading at
To
$5, maybe I'll think
your
about
class.
it. Oh, I have to mute you, Gata. Okay. Maybe I'll think about it because that time it's going to be an interesting at an interesting valuation. That could become more of a year. I'm just do my the portion of the swing trading at $40. This valuation with so much of a risk. No, not for me. All right, what we'll look at why it's difficult to. Okay, okay. Maybe we'll come back to this. There are many ETFs that I'm seeing, so maybe I'll add more to the content and we'll discuss next week. There are many ETFs that I'm seeing in the market that are trying to cash in on the aura that ETFs have, right? Mutual funds, super expensive, ETFs, investor friendly. That's how the overall feeling when you hear about ETF is what we get as an investor. ETF, yeah, ETFs are good. Now, there are many ETFs that are coming in the market which are actually not good. So maybe next week we'll talk about some of those ETFs. Merger. Oh, where is that one around? Yeah, okay. And then we'll jump onto some stock comparison. How to turn 1 million into 46K annual paycheck. Right. Now you can change the number. If you got a 10 million, you're looking at, I don't want to do any, if I can get 460K, if you have 10 million, you can get 460K annual paycheck. If you have a 500K, you can generate 23K annual paycheck and without risk. Or let me put it this, as risk-free as you can get. There are risks involved even if you're investing in a T-bills. We have talked about that risk, which is your risk around timings, right? So this is a little different. This is not investing in T-bills, but is investing in TIPS, which is called Treasury Inflation Protected Securities, right? So today, if you have $1 million investable amount, which you can invest, and you can live your life with 46K. I'm traveling the world. Maybe I'll go and I'm living in South America for next 10 years. I can easily live in 46K. Then you don't have to take a risk of market is going down this year or the next year. You can build your tips ladder by carefully picking up the tips. You can receive nearly 4.6% annually over next 30 years. You don't have to come and spend your Saturday here to figure out which stocks I want to buy. You can use this 2 hours, 2.5 hours to go enjoy life. Right? If you're okay with making 4.6% and you can rearrange your life at that, there are ways to do it. Right? So basically, all it talks about is how to construct a ladder. Now, unfortunately, unlike treasury bills, which probably if you go and want to buy treasury bills, you can buy it for every year, right? bills maturing next year, then maturing in 2 years and 3 years and 4 years and 5. You can basically construct a ladder. Tips, there are not, right? But there are some tools which are available. There's something called tipsladder.com that you might be able to construct a, or you can call up your brokerage firm and tell them that I have an online, Fidelity has got, looks like they got an online tool. Or if your brokerage firm has a fixed income desk, they will do it for you, but they will charge for it, right? Now, some of the financial advisors says, don't put more than a quarter of your fixed income into tips, because if you're investing in any of these, let's say long-term fixed income, you will still have a risk of your value of these tips or T-bills or bonds going down based on what's happening in the interest rate, right? But if you hold it for your maturity period, you're gonna make your 4.6%. Lot of people, including some of the banks, including some of the highly paid fund managers, learned this lesson in a hard way in 2022 when they had a long dated treasury, I would say notes, the T bonds in their portfolio, and they went all crashing down in 2022 when Fed started to increase the interest rates. And that is why I think Silicon Valley Bank, First Republic Bank, couple of those banks, they went upside down, they went bankrupt by holding the least risky instrument on their balance sheet. Those banks went bankrupt because the value will change based on what's happening in the interest rate outside. But if you just hold it, that you don't have to withdraw out of it, you would have still made 4.6% every year. That's guaranteed from US government, right? So that's a risk which you end up, even if you buy fixed income instrument, even if you buy T-bills, if you have to sell it before maturity, then it's anybody's game. Then don't come and tell me, I thought this is a safe instrument. Yeah, safe if you hold it till maturity. If you have to sell it before maturity, then I have no idea what might happen to your portfolio, right? So majority of your fixed income holdings, that's what some financial advisors suggest, should be in a short term, because longer is the duration of your fixed income bills or notes or tips, more susceptible it is to the changes in interest rates. And let's say you bought a 30-year long bond, right? That's why look at TLT. It's been in the drain because it's a 20-year plus, right? So, and if you have to sell it, you'll probably end up selling it at a loss if the interest rate goes higher, right? So, but if you say, I don't need to sell it, I have other portfolio in which can live with it, yeah, you can make 4.6% for next 30 years, provided you just hold it all the way through. Okay. Yeah, Fidelity also has an online tool. If you build the ladder out of treasuries like tips, or you can ask your fixed income desk of a brokerage, but they might charge for you. But if you can, happy with this, then you don't have to take any risk of the stock market. So understand who you are, and there are ways to invest in the market, which is at least better than keeping in your checking account, which yield you 0.01%. 4.6 is multiple 100 times better than that. Well, let's say Ashwin has a question. Go ahead, Ashwani.
Yeah. So the first paragraph that you have highlighted here, it says, as your portfolio is spent down to zero. What does it mean?
Where did
the highlighted portion, last sentence in highlighted portion?
Okay. By carefully constructing, you can receive 4.6% next 30 years as a portfolio spent down to zero. So basically, and the money you receive from tips will rise annually. Yeah, so let's say if you have a 30 years that you want your portfolio to be, right? And you're not gonna exist after 30 years. So if you spend your every year, you can receive 46K and the money to finish if yeah, so basically you've already retired and you're spending your portfolio. So as your portfolio, because you don't have any additional income from your salary, etc., that's what they may say, as your portfolio is spending down to zero, you can get actually 4.6% interest while you are spending for your whatever expenses, etc.
So this 1 million that you put, you get it back, or is it is
so
you
this
just
is the
get
so this is the so one, let's say if you buy tips, right, you might divide this let's say you put $1 million in your treasury inflation protected security. Every year you get 4.6%, and at the end of a maturity period you get your 1 million back. That's how it happens. Now I don't know when you constructed tips, etc. Good question. How will you have access to that 1 million or not? Probably not, because that's what you're getting it for. No, hold on. So you do your 1 million right now, and then, or maybe divide your 1 million into maybe next 30 years and buy tips for 1 year, or then 2 year, 3 year, 4 year, 5 year, that kind of a ladder. If you do, they're not putting all $1 million into tips, right? So you're putting a portion of $1 million for the first year. When that matures, you get your 4%. You get your 4.6% on overall 1 million, because that you've invested over 30 years. Plus you get the proceeds of your investment that you invested for the first year. I think that's how the ladder will
Yeah, you're right. I think they're talking about a drawdown rate of 4.6% every year, which part of which is principal and part of which is interest.
No, this is I think the tips. What is the tips interest rate? Let's go back. Let's go to Treasury Direct.
I looked at the site. It's a good site, but I think they plan to spend it down, and you have nothing at the end, so you take out more each year. It's a good site, the tipsladder.com.
Oh, okay. Oh,
and they show you a catalog of all the available tips bonds and all that.
Tips is a term for 5, 10, or 30 years. I think that's because you don't get it for every year. I think that's why they say maybe go to tips ladder and try to build your own ladder. Interest is paid every 6 months until maturity. This is the auction calendar. Where do I see where the recent tips percent were? The recent auctions on the tips. Let's say auctions. Recent auction result. Does it show tips? Tips CPI data, historical reference. So this will be 2.35. Is it on? I don't know. Maybe this is interest rate plus inflation is what you get?
Yeah, those old ones, Vivek, you buy them at a discount. So something that was issued at 1%, right, today would pay more. So you buy them, old ones, at a discount to create a higher interest rate. But I guess that's why they made that calculator, to make it simple.
Yeah, I mean, I have not invested in tips ever, so I don't know much. But if you want to explore, yeah, the tipsladder.com is what. I find something is interesting, I bring it. Doesn't mean that I'm invested in it. So I've not invested anything in tips. All right, Naresh says Wealthfront does the same. Let me just see. Can you also look at XYZ block? Morris, you have to give me the name of CEO and the market cap. And you bring the story, I'll bring the numbers. Pisheng, about 4.5% is the same one would get from guaranteed income annuity that works like a private pension. Yeah, but I think long back we looked at all the downsides of annuity as well, right? You don't really, how much of money is actually come back to you? Probably nothing. There are other issues around equity, around annuities. So I'm not a big fan of annuity. It has a place for someone who is completely unaware of the market, who doesn't know that there's something called T-bills that exists. Yeah, hand it over to annuity issuers and you'll get 4.5% after your maturity is down. They keep all the money back. And sure, I'm not a fan of annuities. I mean, I can do all the stuff myself and basically keep all the wealth for myself rather than giving it to the insurance company. So I'm not a fan. But yeah, there are people who say, you know what, I don't want to touch it. You just tell me that you're gonna give me this percent every year, and I'm fine with that. Oh yeah, sure. For them, it's fine. Not for me. All right, Ashwin, you had something else. Otherwise, then I have to stop today at 12:15. Hard stop because I need to take my daughter somewhere. So
Okay.
go ahead.
So in this tips ladder, right? If you're not getting your 1 million back,
No, not tips. Tips, you will get the proceeds back, right? So every year, once, if you construct a ladder, every year you get your 4.6% across all of our 1 million. And after the end of first year, whatever the portion you invested for first year, you get back the proceeds, whatever you invested. There was a question on annuity, and annuities works in a very different way. I'm not a fan of annuities.
Okay, so you get your million back in this case, right?
Yeah.
Okay.
Rajiv say one should compare 4.5% against the erosion in purchasing power. That's why it is tips. Tips is inflation protected. So the return that you get on tips will increase if the inflation has gone high or decrease if the inflation has gone low. That's the difference between the tips and the treasury bills. Treasury bills, you get a fixed return, whatever, or the notes. Let's say you buy a 20-year T note or bond, 30-year T bond, your return is fixed. In tips, it changes. So again, I'm never invested in tips, so I'm not the best person to tell you the deeper questions. Go and do some research. I've given you tipsladder.com, and maybe we can find something, we can come and talk about it. All right, let's move to the stock comparison for next 25 minutes. Okay, so which one do I have? Any sectors that you are interested in? Let me put it that way. To compare stocks between different sectors. So I just did today morning. Which one I had? Okay, let's start with this one. This is comparing the retailers. If you have something, you tell me. Otherwise, I think I have a retailer, fintech, South Asia apps, cybersecurity. I'll bring those 4 or 5. So retailers, looking at Baba, SE, which is C Limited, Mercado Libre, Coupang, JD. I don't have Amazon in it because, of course, Amazon retailer, but most of their money is coming from AWS, right? So what do you want to talk about it? Looking at Baba, it's again, these Chinese companies, when it comes to the valuation perspective, still much cheaper. I mean, this is now, it's not as cheap as what they were earlier, but compared to the other players, I feel these are still a good deals to have, provided you can live with the risk of CCP coming and taking away these companies, which is always be the risk if you're investing in any Chinese companies, right? So that's why position sizing is very important. But looking at a Baba forward PE of 13, 14, much cheaper than what you get on S&P 500. Been a great free cash flow generator, 5.85% free cash flow yield. What more can you ask for? It's a $62 billion cash, overall $300 billion market cap. What interests me is out here. This is what I want to look at. Nice gross margins. Dividend yield. Baba also pays dividend. So if you are a dividend investor, you get, apart from a capital appreciation, you got what, 1.41 dividend yield that you have. They've been buying back shares. One of I think over the last 2 years, like Baba has been buying back almost 5% shares per year, kind of a stuff, right? So because the shares are so low, and it's a good capital allocation decision by the management to buy back the shares when the market is not valuing them. Operating margin low because of the retail business, as you can see across all the retailers. Not, you can't expect operating margin of 40% that we are used to seeing in the tech companies. At the end of the day, these are the retail companies. You don't have that big a margin in retail companies, right? It's all the game of volume. Or if you have another business like Amazon has got AWS, Baba has got the Alibaba cloud, but they are what, third when it comes to overall cloud business in the world, right? Look at a real free cash flow. $18 billion of free cash flow. This is, I think Baba have reported, this is as of, okay. So Baba has got a March cycle. So this is like 1 year old. This is the annual data. So maybe we should revisit this after the March 2025 data is around, right? Looking at, others, I think they have December cycle. All others have December cycle. So we have our latest data for them. Mercado Libre, which is, I'm a big fan of the company. You guys already know this is my biggest individual stock position. Good gross margin. They don't pay any dividend. They're reinvesting everything in building the warehouses and logistics. Still generate nice cash flow, $6 billion of free cash flow, 8% free cash flow yield. What more can you ask for? I think I'm going to own this company for another 15, 20 years. Right? Coupang, mostly it's focused on South Korea, now expanding into Taiwan. Again, very early stage. Mercado Libre has got a payment systems, which is helping them on their margin side, etc. Right? They got a Mercado Pago, which is at a much better margin business than their e-commerce business. Coupang doesn't have any of that sort. They have a Coupang Eats, and then they have the Play is very small, Coupang Play, but majority is e-commerce, and pretty strong in South Korea, and now they're expanding. Like I said, they're expanding into Taiwan, and probably also looking to go into Japan. They were in Japan a few years ago, and they figured out they can't scale profitably over there, so exited it. Now the playbook that they've done in Taiwan, I think that's the play. Now they figured out how to maybe scale in an environment which is outside of Korea, and that's why they're looking to maybe go back to Japan and say, now we can spend it. Love listening to their CEO, Bom Kim. Pretty shareholder friendly, focused management, and that's why I'm in this company. Looking at a JD, if you don't want to put all your eggs in one retailer, JD is another one in China. JD.com. Again, from a valuation perspective, both of them are available at much better valuation than what you can find in US stocks, but they also come up with a risk around CCP could one day come and say whatever, right? They can come and nationalize the companies. So that risk is there. Over 3-year data, again, 1 year means nothing. Over a 3-year data, I think story doesn't change much. SE, sorry, I missed that, which is C Limited, focused primarily in Indonesia and now also on Brazil. They have had their tough time during, all the stocks, not only I think SE, but all the stocks. Chinese stocks have got a different problem because of the economy and what's happening to China real estate. But C Limited had the whole problem that a lot of tech companies went through in 2021. The stock was pumped up way higher than what it was worth for. But good thing is, if you listen to their CEO, I think Forrest Lee, in terms of in 2023 and 2022, they changed their focus on, we're not gonna be looking at mindless growth, but we want to grow profitably, right? So some of the businesses that did not perform, they did not invest in it. It had its own issues of, India banning their the most downloaded game in the world called Firefly. Now India have decided probably they will allow it again. And they have also fixed the margins and did a lot of cost cutting. Now the stock has responded back to it. So I think I'll still hold it. They're also now expanding in South America. So when you look at and go through the Mercado Libre earning, there'll be questions around what happened to SE. I'm like, are you on both? You guys can fight out among each other. Who wants to be the best in Latin America? I own both, and will be happy with either one of them. So, any other questions you have on retailers? So, what else we want to look at? Let's pull cybersecurity. Let's see which ones I had for cybersecurity. Okay, 226, not that bad. Maybe we'll get the latest one for this. I think January, July 2024, December. Okay, I have some of them have a year ending in July. So probably not that useful for comparison, but let's look at overall, how this CrowdStrike, Palo Alto, I got a Fortinet, Qualys, and Zscaler. Let me get the latest TTM data around PE, etc. So looking at a CrowdStrike, right? No value investor will touch CrowdStrike. Let me say, when I say value investors, the traditional value investors, right? Which is like, I want to buy the low PE stock because its forward PE is like 103, right? All you're doing is you're paying up for the growth that the company is doing. And all they're doing is they're investing back in their business, and hence they don't have earnings to show. Right? Their net income is even negative for last trailing 12 months. This is all a growth story. Palo Alto is kind of a middle. Right? CrowdStrike natively built platform for cloud-based security. Right? And I know some of you are probably way more familiar with this space than I am. So correct me if I'm saying anything which is egregiously wrong. But Palo Alto Network started as a firewall. Now they're trying to patch together. They've done a lot of acquisitions, try to change into a platform-based cloud security company, right? Fortinet. Now some of these companies, Fortinet and Qualys, if you look at their financials, there's a great financials. But that's where, when you're trying to invest for future, it's not just the past financials that matter. What also matters is what's your future growth story is. Looking at a past financials, like if you look at a financial, CrowdStrike has got a worse financials, right? More reds than others. Look at Fortinet and Qualys. Amazing. If I'm an accountant, I'll only buy Fortinet and Qualys. Great gross margin, right? Decent buybacks, 30% operating margin, good cash flow company. What is not there is a growth. Where is the growth? Whereas the cybersecurity companies are growing, you do not have growth. So these are the companies which is, yeah, I will return capital to you, I'll buy back shares, maybe I'll pay you dividend. But that's it. Don't expect too much from me. I am already a maturity stage of my company. Maybe 10, 15, 20 years, I'll get into declining stage, return all the capital to all the shareholders. I'll be done with it. So these two looks to me at more at a very mature stage, not much growth expected out of future. But that also means the stock's going to be less less volatility than others, and you'll continue to get your dividend, maybe some buybacks, etc. They don't pay dividend, but they're both of them are doing basically buying back the shares. So I'm not saying these are bad companies to buy, but depending on what kind of investor you are, look at it. These might be a candy to some of the value investors, right? I don't want to pay up for a company. Yeah, these are available at not that cheap, but at least cheaper than the rest. Right? When it comes to the industry side, it's cheaper than the rest. And then they're generating free cash flow. They got 2.5% free cash flow yield. But what they don't have is they don't have a growth. And then the market is forward looking, and that's why they are not awarding it the same valuation what they would do to others. So we would call it $4 billion company. Zscaler probably maybe look a little more interesting now. What's the Zscalers? PEG is 3, PS, it's still a little expensive. But yeah, maybe I own CrowdStrike. I don't own any one of these. But if I were to, maybe Zscaler may be the one I might want to look at. I know the market gives a lot of credit to Palo Alto Networks, but again, to me, that looks like more of a hodgepodge of different companies welded together to convert them from a prior firewall-based company to now new cloud-based platform. And again, they have a big CrowdStrike as a big competitor over there. So if you're in a CrowdStrike, the financials will be bad, but it's all about the story of the future. If you are in a college, it's all about the past. The future is not that great. The company is not growing, and that's why the market is keeping its valuation of $5 billion, because it looks to be past its prime. Anyone from a security industry, or cybersecurity? Where is? He dropped off. Oh, okay. So Gata, what do you think on Qualys and Fortinet? Maybe you know more about this. I've never worked in a cybersecurity industry. I'm looking only at what the numbers are telling me.
But CrowdStrike has very good marketing strategy. That is one problem. But if you see the facts from your data, the reality is different, basically.
Yeah, so it's all right now. It is all about the revenue growth.
Yeah, true.
Yeah, that's all. It's about the growth of revenue and the continued revenue growth in future. The numbers are bad because they are reinvesting everything. And if the revenue growth comes down, the stock will crash. It's all about the future revenue growth. The past numbers are not that attractive. So depending on what kind of investor you are, you construct or pick up those companies accordingly. What else do you see? How about on the cybersecurity groups? What's your thought process, or what do you hear in the market around Qualys or Palo Altos?
Qualys has been good. There is no second thought. But CrowdStrike has the problem is recently because of the attack was happened few months back. That has a negative impact. But the way they are going, the marketing strategy to get the new orders, that is where the people has to see one point. But if you go by the data, Qualys looks very good compared or Fortinet. These two things are.
Yes. So if you're running a screener in terms of the let's say good stable companies, these two called Fortinet and Qualys will show up. The question is the market, how much is market rewarding them for future? Not that great. Qualys has been in range bound. right, for over last 3 years. Hasn't done much because this company is not growing. When the market overall multiples expand, it'll go high and then contract. So it's a stable business.
Yeah,
It's
stable
a good
business. That's true.
business. It's a stable
Mhm.
business, which is good business, but not growing. Don't expect too much from me in future. I'm already now above 50 years of age or above 60. Don't expect that I'm gonna come and do a new dance, right? A teenager, and whereas the CrowdStrike is in the early 20s. There are a lot of the recent history is bad because they just graduated from college. They have done a lot of shit in the college. Their history is bad, but the future may be there. And if you're investing in CrowdStrike, you're paying up for the future, which sometimes could be risky also. I mean, that's the risk you take, but then that's where you get paid to buy it now. If CrowdStrike, if that early 20th gentleman becomes, much better when it reaches its 40th age or 50th age. All right, so that's a cybersecurity. What others? We got 5 more minutes. What other sectors do you want to compare? Or let me see what else I have. I have fast food. Will this work? Okay. So this was last on. Let's do 329. FinTech. So I got PayPal, SoFi, Block, XYZ. Okay, we're gonna do Block now. Someone had asked for Block, right? Uh, Upstart, UPST, and New Holdings, which is Brazilian bank. So let's see what we find from here. So looking at from a valuation P ratio, PayPal 16, much cheaper than the market, and we know why it is. We talked about PayPal earlier also. Overall, $31 billion of revenue, $4 billion of net income, so decently profitable. Debt of $11 billion, $64 billion market cap, not a huge market cap company. It was big at some point of a time in 2021, where the share was maybe around $300. I think that's what it had reached. And now it's back to $70 or something. Maybe was it 300, or am I confusing it with someone else? PayPal. Let's go back to 5 year. Oh, 310. Right. But it's a good still generate decent amount of a free cash flow. So trading 12 months, you got a 10% free cash flow yield. SoFi, which is a darling of a lot of retail investors, started as a company which is focused on student loan. Then slowly they bought up a few companies. They bought a mortgage company and they got a banking license. Now they're now into almost everything, right? But it's not cheap. Maybe you're paying up for a growth, right? So if you look at overall $2.6 billion of revenue and 479, let's say $2.5 billion revenue and $500 million of net income. Debt to equity is all fine, except wow, UPS got 2.43 debt to equity. That's a little concerning. A $2 billion of cash, $12 billion market cap, no free cash, negative free cash flow. EPS is very small. XYZ, which is Block, have been just sideways, moving around sideways. I don't know. Sometimes I feel that, I mean, I own PayPal, I own XYZ. I don't own the other stocks. But it's been a rough ride with XYZ because now the CEO or the founder kind of became a Bitcoin libertarian, right? So, and then they also did a very expensive acquisition of Afterpay, which is now basically hurting them because the whole BNPL segment, I mean, while the others are growing, Klarna and which is the other one, the Affirm, yes. But my thoughts on BNPL. I mean, it's a different level. Or at the end of the day, it's still a debt. You may package it in a different way, but at the end of the day, you are still taking more debt as a consumer. And if you're not careful, maybe in a few years, you will realize that whole BNPL is not as great for consumers as what the companies promoting it have been talking about. Right? It is basically your receivables discounting business model when it comes to BNPL. Anyway, XYZ not been a great history. Revenue of $24 billion, net income of only $2 billion, which is, I mean, they've been around for much longer, right? Decent free cash flow of 4.3% over there. UPST is where I have most fun in terms of what the heck are they trying to do. They only work out well when the economy is doing good and when your interest rates are lower. It went through its own hype cycle, and I remember having discussions around UPST in our meeting. Why you're not investing in UPST? I'm like, let them go through one recession cycle, let them go through one bad cycle, then I will see how they are performing. And that's it. What happened was we had 2022, interest rates are higher, and then they start to have all their AI models of picking up the best customers to give them loan to, fell by wayside. Anyway, I'm a little skeptical of those new AI models unless you have gone through a couple of economic cycle, right? In a low interest rate environment, every company will look great. It's like if I'm on Snapchat or whatever, where you have those beauty filters, etc., I might look that great, but in reality may not be, right? So in low interest rate environment, each one of these companies were, there as if nothing wrong will happen. Once we have interest rate started to go high, all their models started to break. Last is new. This is what, if I were to add any one of these, probably I'm going to look at new. It's one on my radar. Berkshire Hathaway had invested in it. And my only thing is, because I also have Mercado Libre, which is Mercado Pago, they have a payment side. At the end of it, this is a financial services company. Right? So over a long-term period, their returns will be probably similar to what the bigger financial services company do. But this is the one company which they have grown like crazy in terms of their number of mobile banking consumers. They have more mobile banking users, I guess, than Bank of America has. Right. So this is on my radar. Maybe if I have if my portfolio is looking for another company, and if it is available at a decent valuation, this is something that I might want to look at. Right. Numbers wise, except PayPal, I think everyone else's numbers are, everyone else's numbers are really bad. PayPal, the business is good. The stock went up really high on the expectations of PayPal becoming a super app. And then, of course, they had to let go the CEO. They brought in a new, fresh blood. And that's what last year we were talking about it. PayPal around 50. I said, I'm going to add to my position. And so over the last year, I built a position in PayPal, and I like the new management and what the pace of innovation that they have done. I've not seen PayPal coming up with so many new products over the last 5 years as what I've seen in the last 1 year. So I'm still hopeful that market will eventually figure out that the company is not dead. Maybe they're going to a phase 2 and rejuvenate themselves, but time will tell. Right? And new is something that I told, probably something which I will look at. All others are all the stories of future, right? So if XYZ is only because of their focus on Bitcoin, etc. I'm like, I'll still hold it. Not a huge part of portfolio, and I've been in the stock for quite some time. It's not been a good stock, losing money on it, but let's see if they can figure something else on the Bitcoin side, right? Upstart, never invested, and I don't think I want to invest it at 40% negative operating margin. Forget profit margin, operating margin is minus 40%. Why would I touch it? All right, so we hit our 12:15. I need to drop off and do my parental duty. Okay, I hope you like the stock comparison. If you have some other sectors or the companies in mind, do let me know. And maybe I can bring up this side-by-side comparison for you to decide on which company, because you have all of us have limited capital, right? So it's always a trade-off that we have to do between X, Y, Z, which company do I have to invest in, right? So this comparison helps me to decide. Again, it's not a final decision, but looking at this, I'll say if I were completely new and looking at this, I would say maybe I'll go and study new more, right? And maybe upstart will be completely, I'm gonna throw it out, and then maybe XYZ and the papers, I'm gonna still keep it on radar, and it's things like that, right? So, and you don't have to spend too much time on doing this. All right, guys, that's all for today. Thank you for joining in, and let's hope that next week we will, April 2nd, we'll get a little more clarity from the administration. Even if we don't, come on, it's just 1 year. We have had 2 wonderful years, 2023, 2024, and even if we don't do this year, should be perfectly fine. Long term, 1 year doesn't mean anything. All right. Thanks, great. Vijay, that's great. I'm glad you liked it, and I hope to see you here next week as well, Vic. Cool. Thanks, everyone. Bye-bye.
Thank you, Vivek.
You're welcome.